The end of financial year is approaching, and I'm going to talk you through the tax office's key target areas this tax season. Now, this is relevant for you because the tax office's data gathering processes are getting much better. And with the estimated tax shortfall coming mainly from individual taxpayers, it's important that you don't end up on the ATO's target list. Now keep in mind, I'm not a licensed financial advisor. This video is for educational purposes only. Let's first talk about crypto. An estimated 1 million Australians now invest in cryptocurrency, and the tax office is collecting data from crypto providers. For most people, when you buy and sell cryptocurrency, it'll either be a capital gain or a capital loss. The important thing is to keep your records around your purchase and your sales. Now, if you buy a cryptocurrency and you're an individual, generally if you hold it for 1 year or longer, and you sell and you make a gain, you can claim a 50% discount on that gain. But if you're on the other side, if you make a capital loss, you can't claim it against your tax return straight away. Capital losses really suck.
You suck!
You have to carry forward that capital loss to offset against any other capital gain that you might make in the future. On the plus side, any fees that you incurred in buying and selling can be included in that calculation, so you're losing the benefit of those. What's key here is that cryptocurrency is in the target area of the tax office. You won't be able to hide your transactions. So make sure you have your documents saved down, ready to go for calculating your capital gain or your capital loss. Let's next talk about the side hustle economy. An estimated 700,000 Australians supplement their income with side hustles, things like Uber, Uber Eats, Airtasker, Airbnb, those sorts of things. And like crypto, the ATO is now receiving reports from some of these providers. The important thing here is distinguishing between a hobby and a profit-making business. Something that you do once in a blue moon, like maybe once a month, you perform a task where you run someone's rubbish to the tip on their behalf and receive some money for that. That could possibly be a hobby. However, if you start doing activities more frequently and you have a level of sophistication around what you're doing, such as Airbnb, then that's taken to be a business. And business profits and expenses need to be included in your tax return. The distinction is if it's just a hobby, you don't need to include those items in your tax return. However, if you are claiming that it's just a hobby, make sure it's very infrequent and you've got some good evidence to demonstrate it is purely a hobby, because it's a very fine line. Let's next talk about work-related expenses. This is where the large tax gap is coming from. The ATO has estimated there's an $8 billion shortfall in the tax that individuals should be paying and what they are actually paying through claiming tax deductions. There are 3 golden rules in claiming a work-related tax deduction. The first is you must have spent the money yourself. The second is it must directly relate to you earning your income. And the third is generally you must have documents and receipts to support the claim. There is some concessions around that, but if in doubt, save a receipt. And if the expenditure is a little bit personal and a little bit related to work, so an example could be a computer or a laptop that you use for work, but perhaps you also use for gaming or something like that, then you need to apportion the tax deduction that you're going to claim. And you need to do this on a reasonable basis. I'd recommend just keeping an Excel sheet or some sort of document, explain how you've come up with the apportionment. And if you're worried that you're missing out on tax deductions, the ATO has an industry guide on their website, which shows you some of the expenses that you can claim relevant to your industry. I'll leave a link in the description below. Now, if you spend $300 or less, if you're claiming tax deductions for $300 or less, then you actually don't need receipts. Anything over that amount, then you do need to keep receipts. The Labor government's proposed announcement of $1,000 tax deductions without proof doesn't start till next year, 2026. My key recommendations here are don't miss out on any tax deductions that you should be claiming. Check out the industry guide. Some other common things that are missed are last year's tax agent fees, any income protection insurance that's outside of your superannuation fund, financial advisor fees, interest, but only if that interest is directly linked to an income producing asset, such as an investment property or a share portfolio. And make sure you keep receipts and documentation. There are concessions around that, but what I simply do is take a photo of my receipts as soon as I get it, upload it to the cloud, then I have it there forever and always. And with your work from home deductions, don't do what this company director did.
We had a company director claim their treadmill, juicer, coffee machine, I think their gaming console and a bunch of other stuff as working from home expenses. Now, in both of those, they're private in nature and you can't claim them on your tax return.
Those do not have a close enough link to you earning income and they are not deductible. The important thing with work from home deductions is that you actually must be working from home. Just checking the odd email, that sort of thing, that's not considered working from home. It's good to maintain a diary or a calendar on the days that you work from home to substantiate the hours that you are working from home. And the ATO allows 2 different methods for you to claim your tax deductions. The actual cost method, this is a little bit painful. You're supposed to figure out how much energy your home office is using by checking the appliances and then comparing that to your cost per energy usage on your power bill, plus all your other expenditure. A little bit more effort, bit of a pain. If you have the time, maybe do that. Well, there's a shortcut fixed rate method, which uses the number of hours that you work from home, times that by 70 cents, which is the year for 2025. And that is the starting point of your tax deduction. Using this fixed rate method means you can't claim things like pens and paper and other expendable items like that. But what you can also claim is the depreciation on home office equipment separately. Things like your monitors, your desk, your chair, your keyboard. Those items can be claimed as a separate tax deduction to the 70 cents. And if the item of expenditure is under $300, you can claim an immediate tax deduction for that, which is really good. If it's over $300, then you have to actually claim that tax deduction over a number of years. It's called depreciation. Let's talk about holiday homes and investment properties. The importance of this is in a recent ATO finding, they found that there was 90% errors in tax returns that include investment properties. The important thing to remember here that if there is a portion of the year where the house is used for a personal use, then you may need to apportion some of your tax deductions between work and private. It's okay if the property remains vacant for a period of time, but you must be able to demonstrate that it was available for rent. So things like Airbnb listings, make sure you keep a copy of those sorts of listings. Another target area of the tax office is if you own the investment property jointly and it's 50-50, then you also need to spread the tax deductions on a 50-50 basis. For example, if one of the owners has a higher taxable income, you can't allocate more tax deductions to that person to bring down their taxable income. The tax deductions and the income need to be split in line with the portion of ownership. The golden rule here is if you can't substantiate it, you can't claim it. So again, make sure you keep records and receipts of all your expenses. Make sure you visit the ATO website so you're not missing out on any tax deductions related to investment properties. And make sure you split those tax deductions and income in the same portion as the ownership, which generally will be 50-50 unless you have a very specific agreement. Now, I've done a separate video on some tax planning opportunities that you need to do before 30 June. So make sure you check that video out. I'll leave a link to that. Hope you enjoyed this video. And if you made it this far in the video, comment the word tax deduction so I know who you are. Thanks for your support. See you in the next video.